Most people assume markets move when something obvious happens. A war starts, a central bank announces a rate decision, a company reports earnings, then the price reacts. That's the story we like to tell ourselves. But markets rarely work that way. In reality, markets often move long before the headline arrives. Not because investors are psychic, but because the structure underneath the market starts to shift quietly. Inventory levels change, liquidity tightens, delivery demand increases, or positioning becomes crowded. By the time the news becomes widely discussed, the adjustment has usually already begun. Right now, something similar may be unfolding in the silver market. Not in the sense of a dramatic event that everyone is talking about, but in the quieter mechanics that determine how physical metals actually move through the financial system. Most investors focus on price charts. A smaller group watches macroeconomic news. But professionals often pay attention to something else entirely: the plumbing of the market, inventory levels, delivery requests, financing costs, the relationship between physical supply and paper claims. Those signals rarely make headlines. They don't trend on social media. Yet historically, they've often been the earliest indicators that something in the market structure is changing. So before we talk about opinions or possibilities, let's step back and look at what has actually happened in the silver market recently. Just the data, nothing more. Over the past year, several measurable changes have appeared in the structure of the global silver market. None of them, on their own, are unusual, but together they describe a shift worth paying attention to. Start with inventory. Data published by the Chicago Mercantile Exchange shows that the amount of registered silver, metal designated and available for delivery on the exchange, has declined compared with levels reported roughly a year earlier. Exchange inventory reports indicate that registered stocks moved from roughly 120 million ounces toward the 80 to 90 million ounce range during that period. Registered inventory represents the portion of metal that can actually be delivered against futures contracts. Another category, known as eligible inventory, refers to silver stored in exchange-approved vaults, but not currently designated for delivery. At the same time, futures trading activity remains large relative to the amount of registered metal. Silver futures contracts trade daily on the COMEX, where the majority of contracts are settled financially rather than through physical delivery. This structure has existed for decades and is standard for commodity futures markets. However, exchange delivery reports from earlier this year showed a noticeable increase in requests for physical settlement compared with typical January activity, a month that historically sees relatively limited delivery volume. Another observable change involves short-term financing conditions for the metal itself. In the precious metals lending market, the lease rate for silver, the cost to borrow physical silver, has risen compared with the extremely low levels seen in previous years. Lease rates historically fluctuate depending on supply availability and short-term demand for physical inventory. Market structure signals have also appeared in futures pricing. At times during recent months, near-term silver contracts have traded at higher prices than contracts further out on the curve. This condition, known as backwardation, can occur when immediate demand for a commodity becomes temporarily stronger than future delivery demand. None of these data points alone imply a specific outcome. They simply describe what has changed in the market environment compared with earlier periods. To understand why these shifts matter, the next step is to look beyond the individual data points and examine the chain of cause and effect that links them together. When people look at the price of silver, they usually see a chart, a line going up or down. Maybe they connect it to inflation, interest rates, or the US dollar. But the price is only the surface. Underneath that surface sits the structure of the market itself: how contracts are traded, how inventory moves, and how physical supply interacts with financial claims. Silver, like many commodities, trades primarily through futures markets. On the COMEX, participants buy and sell contracts representing future delivery of silver. These contracts allow miners, refiners, manufacturers, and financial investors to hedge price risk. Most of these contracts never result in physical delivery. They are closed, rolled forward, or settled financially before expiration. That system is normal and has functioned for decades across commodity markets. However, the system depends on a simple condition: only a small portion of contracts request physical settlement at the same time. If delivery demand rises while the pool of metal designated for delivery falls, the mechanics of the market start to tighten. Not because the system is failing, but because the balance between paper claims and available inventory becomes more sensitive. Think of it less as a shortage and more as reduced flexibility. When inventory is abundant, large delivery requests can be absorbed without much impact. When inventory declines, each delivery request represents a larger percentage of available supply. Market participants begin paying closer attention to who holds physical metal and who needs it. This is where secondary effects begin to appear. First, borrowing costs for the metal can increase. In the precious metals lending market, silver lease rates sometimes rise when short-term demand for physical inventory grows relative to available supply. Second, futures prices may temporarily shift shape. Periods of backwardation, when near-term contracts trade above longer-dated contracts, can occur when buyers are willing to pay a premium for immediate delivery rather than waiting. Third, industrial supply chains start to watch the market more closely. Silver is not only a monetary metal, it is also a critical industrial input used in electronics, solar panels, and electrical components. According to data compiled by the Silver Institute, industrial applications represent a significant share of annual silver demand. If physical availability tightens, manufacturers, not investors, are often the first to react. Their priority is continuity of supply, not price speculation. That distinction matters. Financial markets often react to price changes quickly. Industrial users react to supply reliability. When supply reliability becomes uncertain, purchasing behavior can change well before the broader market notices. None of this guarantees a particular price outcome. Markets adjust in many ways: inventory flows, increased production, substitution, or simply reduced demand. But when structural signals begin appearing simultaneously, inventory movement, delivery demand, financing costs, and futures curve shifts, it suggests the market's internal balance is evolving. Understanding that balance is often more useful than focusing on headlines or short-term price swings. And to put that balance into perspective, it helps to look at moments in the past when the silver market experienced similar structural tension. When analysts try to understand a commodity market, they often look backward before looking forward, not to predict the future with certainty, but to recognize patterns in how markets behave when certain conditions appear. The silver market has experienced several periods where price movement accelerated after a shift in macroeconomic or financial conditions. One of the most widely discussed episodes occurred in 2011. During that period, global financial markets were still adjusting to the aftermath of the 2008 financial crisis and the large-scale monetary stimulus programs that followed. Central banks, including the Federal Reserve, had implemented aggressive quantitative easing policies intended to stabilize financial markets and support economic recovery. Inflation expectations rose. The US dollar weakened for a period, and investor interest in precious metals increased. Between 2010 and April 2011, the price of silver rose sharply, eventually approaching $49 per ounce, its highest level in decades. However, the path upward was not smooth. Futures exchanges raised margin requirements several times during that period as volatility increased. Those adjustments reduced leverage in the market and contributed to a rapid price decline shortly afterward. The lesson from 2011 was not simply that prices can rise quickly. It also demonstrated how market structure and leverage can influence the speed of both rallies and corrections. Another episode occurred in 2021, shortly after the widely publicized short squeeze in several U.S. equities. Some retail investors attempted to create a similar dynamic in silver markets by purchasing silver-related assets and discussing coordinated buying across online communities. Silver prices did move higher for a short period, and retail coin dealers reported strong demand for physical silver products. However, the attempt did not produce a sustained supply disruption in the futures market. Several factors limited the impact. Much of the buying occurred through exchange-traded products rather than direct physical purchases, and the broader market remained significantly larger than retail participation alone. These historical examples illustrate an important point. Commodity markets rarely move for a single reason. Price movements typically emerge from a combination of macroeconomic conditions, physical supply factors, investor positioning, and market structure. The current environment shares some similarities with previous periods. Changes in inventory levels, shifts in macroeconomic policy expectations, and renewed interest in precious metals. At the same time, several variables are different today, including global industrial demand patterns and the structure of commodity supply chains. History does not repeat itself exactly. but it often provides a framework for asking better questions about what might come next. And that is where scenario analysis becomes useful. Professional investors rarely frame markets in terms of certainty. The language tends to be conditional. If this continues, then that outcome becomes more likely. The purpose isn't to predict a single future, it's to prepare for several plausible ones. Looking at the current silver market environment, three broad scenarios help organize the possibilities. Bull case, tight supply meets persistent demand. For the stronger scenario to unfold, several conditions would likely need to persist at the same time. First, physical inventory would need to remain constrained relative to delivery demand on exchanges such as COMEX. If requests for physical settlement continue at higher than normal levels, while registered stocks remain limited, the market supply buffer could stay narrow. Second, industrial demand would need to remain steady or grow. According to research compiled by the Silver Institute, a significant portion of global silver consumption comes from industrial applications such as electronics, solar technology, and electrical components. If manufacturing activity in these sectors remains stable, underlying demand for silver could remain structurally firm. Third, macroeconomic conditions could reinforce investor interest in precious metals. If inflation remains elevated or real interest rates decline, some investors may continue allocating capital toward metals historically viewed as monetary hedges. If those factors occur together, tight physical inventory, stable industrial demand, and supportive macro conditions, then prices could remain firm or trend higher over time. However, this outcome depends on several variables continuing simultaneously. Base case, market rebalances gradually. In many commodity cycles, the most common outcome is not a dramatic move in either direction, but a gradual adjustment. If inventory levels stabilize and delivery demand returns closer to historical averages, the silver market could simply rebalance. In this scenario, producers may respond to higher prices by increasing output from existing mines where possible. At the same time, refiners and distributors could shift metal between regions to meet localized demand. Financial markets also tend to adapt quickly. Futures spreads can normalize as liquidity improves, and borrowing costs for physical metal may decline if supply becomes more readily available. Meanwhile, macroeconomic policy expectations could shift. For example, changes in interest rate expectations from institutions such as the Federal Reserve often influence investor demand for precious metals. If real yields stabilize and inflation expectations remain contained, investor flows into metals might remain moderate rather than accelerating. In this base case, silver prices could move within a broader range, while supply and demand gradually find equilibrium. Bear case, demand weakens or supply expands. A weaker scenario would likely require a change in one of the key drivers supporting the market. One possibility is a slowdown in industrial demand. If global manufacturing activity softens, particularly in sectors such as electronics or renewable energy, industrial consumption of silver could decline. Because industrial use represents a substantial portion of annual demand, even modest changes can influence market balance. Another possibility involves an expansion in available supply. Commodity markets often respond to higher prices by increasing production where economically feasible. If new supply enters the market or previously withheld inventory becomes available, the perceived tightness in the market could ease. Financial conditions could also shift. If interest rates remain elevated or strengthen further, higher real yields may reduce investor appetite for non-yielding assets, such as precious metals. In past cycles, shifts in monetary policy expectations have sometimes redirected capital toward other asset classes. If several of these factors occur simultaneously, industrial demand slowing, supply improving, and financial conditions tightening, then the silver market could experience downward pressure. None of these scenarios is guaranteed. Markets rarely follow a single clean path. Instead, they tend to move through phases where different forces temporarily dominate. The key for investors is not identifying the correct scenario in advance, it's understanding what conditions would need to change for each one to become more likely. And that leads to the next question. Which signals actually matter when monitoring those conditions? When markets start to shift, the first signals rarely come from headlines. They appear in a handful of data series that professional investors watch almost every day. None of these indicators tells the full story alone, but together they help reveal how capital and liquidity are moving through the system. One of the first is the US dollar index, commonly referred to as DXY. The dollar tends to have an inverse relationship with many globally traded commodities because those commodities are priced in dollars. When the dollar strengthens, it often places downward pressure on metals priced internationally. When it weakens, metals sometimes gain relative support. Interest rates are another important variable. Movements in U.S. Treasury yields, particularly real yields adjusted for inflation, can influence investor behavior toward precious metals. Historically, periods of falling real yields have sometimes coincided with stronger interest in metals because the opportunity cost of holding non-yielding assets becomes lower. Inflation data also matters, but not necessarily the way it is discussed in daily news coverage. Market participants often watch measures such as the Consumer Price Index, CPI, and the Personal Consumption Expenditures Price Index, PCE, because they influence expectations about monetary policy decisions from the Federal Reserve. If inflation data surprises to the upside, investors may reassess how long interest rates will remain elevated. If inflation moderates, expectations about policy easing could shift as well. Beyond macro indicators, there are also signals inside the metals market itself. Trading volume and liquidity help show how strongly market participants are committing capital. Sudden spikes in volume during price moves can indicate stronger conviction behind a trend, while low liquidity environments can sometimes exaggerate price swings. Another metric professionals watch closely is open interest in futures markets, such as those operated by the Chicago Mercantile Exchange. Open interest reflects the total number of outstanding contracts. Changes in open interest alongside price movement can help reveal whether new positions are entering the market or existing positions are simply being closed. None of these indicators predicts the future on its own, but together they form a framework, a way to observe how the market is evolving rather than reacting only to daily price changes. And that perspective helps maintain discipline when markets become noisy. Markets are rarely as simple as a single headline or a single narrative. Silver, like any commodity, sits at the intersection of multiple forces: industrial demand, monetary policy, global supply chains, and investor positioning. At times, those forces align in ways that attract attention. At other times, they offset each other quietly in the background. The goal isn't to predict every movement in advance. It's to observe how the underlying conditions are changing and adjust expectations accordingly. Right now, several signals in the silver market suggest that participants are paying closer attention to physical inventory, delivery dynamics, and macroeconomic policy expectations. Whether those signals lead to sustained price movement will depend on how those variables evolve over time. This isn't investment advice. It's simply how I'm reading the market right now, through data, through historical context, and through the discipline of considering multiple outcomes rather than just one. In markets, patience and risk management tend to matter more than certainty.